This is Homebuyer Radio with home loan expert Dan Morales. Dan has been one of the nation's leading mortgage lenders since 1991, and weekly he shares with you valuable insight into the home buying process. Whether it's your first home or not, Dan will help you have a better understanding of the home buying process. Let's get started with this week's episode. Dan, what do you have for us this week?
Hey, thanks, Pat. I appreciate the introduction as always. And hey, we're off and running. This is Homebuyer Radio. Tongue twisted here this morning. Homebuyer Radio, episode number 78. And this week, I wanted to kind of continue what I've been talking about recently, which is just adjustable rate mortgages and how they could potentially benefit you as you look at buying a new house. Okay, when it comes to adjustable rate mortgages, to kind of recap what we talked about last week, they come in the most common flavors are a 3-1, 5-1, 7-1, and 10-1 ARM. Meaning the rate is fixed for the first 3, 5, 7, or 10 years. Now, you do get some lenders like us that do these screwball products where it's a 15-year adjustable, right? Meaning that it's fixed for the first 15 years of a 30-year repayment term and then can change annually after that, okay? So when you hear the term, 3-1, 5-1, 7-1, 10-1, 15-1, that just means the initial rate for the first, let's say 3, 5, 7, 10, or 15 years is fixed, and then after the end of that fixed rate period, it can change annually, okay? Those are the most common. The majority of the adjustable rate programs that we have written, especially lately, have been the 15-1 ARM, meaning that the rate's fixed for the first 15 years of a 30-year repayment term, and then it can change annually at the end of that 15 years. Okay. Now, what I wanted to talk about this week is how do you determine what your rate's going to be, right? At the end of that, let's say, 15-year period, what's going to, determine what my interest rate's going to be. Okay. Now, one of the things we want to give some consideration to is, would an adjustable rate product be appropriate for you if you are planning on keeping the mortgage or the house long term? Okay. Typically, when somebody takes these loans, you're taking it with the anticipation of not having that mortgage come, let's say, 3, 5, 7, 10, or 15 years from now, okay? You're kind of betting that mortgage is either going to be paid off within that period of time, or that you're not likely going to be in that same property within that period of time, okay? If you think you're going to, let's say, keep a house for 30 years, you're going to live in it for 30 years, and you're going to make that mortgage payment for 30 years, then an adjustable rate mortgage may not be an appropriate option for you, okay? If it's something where you say, gosh, I know I'm not going to keep this mortgage for 10 years, then an adjustable rate mortgage could certainly make sense for you, okay? Reasons for not keeping a mortgage, maybe you're going to pay the loan off at an accelerated pace. Maybe you plan on selling a house within that 10-year period, and you know that buying this house is just going to be for a 5 to 7 year period, right? Or, maybe you're banking on interest rates taking a drop, and you're going to take the adjustable rate to take the benefit of a little bit lower interest rate, betting on the ability to refinance. Now, there's an element of risk with that, okay? So I'm not sure that I would necessarily approve that strategy. I think part of it has to do with, market rates and so on, and, the difference between an adjustable and a fixed. And those are all things that, a good, competent lender is going to work through with you, so you can make sure you really understand the risk that you take with an adjustable rate, okay? But what happens is, with an adjustable rate mortgage, you generally have caps to how much your interest rate can change, and then you have, the actual math behind how they determine what your rate is going to be, okay? The caps are, what can vary wildly from lender to lender, okay? So if you have, let's just pick one as an option, okay? Let's just say you have a 5-1 ARM, meaning your rate is fixed for the first 5 years of a 30-year term. At the end of that 5 years, your rate can and likely will change, okay? There are typically caps as to how much your interest rate can change, okay? There's usually a cap that limits how much your rate can change on that very first adjustment. Then there's a cap that limits how much your rate can change on the subsequent adjustments after the very first one, okay? So in other words, at the end of 5 years, then your rate can change. There's a cap as to how much that rate can change in that very first change. And then at the end of the next year, so this would be at the end of 6 years, your rate can change again. There's another cap as to how much that rate can change. And then there's what's known as a lifetime cap, meaning that your mortgage can never go over a certain interest rate for the entire lifetime of the loan. Okay. Now, in some cases, that lifetime cap, meaning the highest that your rate can go, you can hit on the very first change if there was a really strong move in interest rates against you. Okay. So that's why I say it's really important to understand the risk that comes into play with these, right? Because as long as you understand the risk, it can also be very rewarding if you play your cards right. Okay. So you have a guaranteed interest rate for the first, let's just say 3, 5, 7, 10, or 15 years. At the end of that period of time, though, your rate's going to change, and then you need to understand what the caps are, meaning how much or what's the maximum my rate can change if I still had this mortgage coming, come, let's say 3, 5, 7, 10, or 15 years from now. What's my new rate going to be, and what is the maximum I can pay under this loan? Okay, those are all things that will break down and help you understand, so you can make sure you know what your risk is if for some reason you still had that mortgage, come the 3, 5, 7, 10, or 15 years from now. Because it's important to understand, if you think you're going to have this mortgage at that period of time, what do we think the balance is going to be? What happens if worst case scenario you have the absolute highest interest rate? What does that do to your monthly payment? Those are all things that will help you understand so that you know what your risk is. But again, if you think you're going to have a balance on this mortgage, let's say come 6 years from now, and you're taking a 5-1 ARM, let's do the math to make sure you understand what that risk is and make sure that the product is appropriate for you. And you're not taking a loan that you shouldn't be taking. Okay, I can tell you, I personally have always financed using an adjustable rate mortgage. Like I said, I've had one fixed rate mortgage my entire lifetime, and I had that for about 6 months before I paid it off in the adjustable rate mortgage. So, if you understand the risk with these programs, in all honesty, you can actually lower your mortgage cost and benefit from using this product as long as you understand it. Okay. We'll help you understand those more. Next week, what we'll do is we'll start to talk about, how they actually do the math behind calculating what your new interest rate would be for, let's say, the subsequent adjustment. But this week, I just wanted to talk about adjustable rate mortgages and the caps, right? So you need to understand that you have a fixed rate for a period of time. At the end of that initial fixed rate period, there are caps, meaning that, there's limits to how much your interest rate can change, on that very first change, and then every subsequent change. And then, of course, there's a lifetime cap, meaning that you cannot exceed a maximum lifetime rate. Okay. Those caps can vary wildly from product to product. Okay. Generally, the highest lifetime cap is 6% higher than where you started. Okay, so if you started with an interest rate of, let's just say, 4.5%, the lifetime cap, typically the highest lifetime cap you would ever see on that mortgage is 10.5%, meaning that, even if the absolute worst case scenario were to play out with that mortgage, you could never exceed an interest rate of 10.5% with that cap of 6%. Okay. Now, how those caps come into play, again, vary widely from product to product, right? You can have a 5-1 ARM that has what's called a 2-2-5 cap, meaning on the very first change, the maximum your rate can change is 2%. The maximum the rate can change on any subsequent change is 2%. And then the maximum lifetime rate is 5%. So if you had, let's say, that scenario, then you would have maybe, let's say, a 5-year adjustable. If, let's just say, the starting rate was 4.5%, when that loan was due for its very first change, the maximum that rate could go to is 6.5%. The maximum it can go to the year after that would be, let's say, 8.5%, and then the maximum the year after that would be 9.5%, right? So that 2-2-5 cap means on the very first change, the maximum change you can take is 2%. The maximum change in any subsequent year is 2%, and then the lifetime cap is 5%. Okay, so that means that if you start half, we know our lifetime cap is 5% higher than when we started, which means we could eventually hit the absolute highest rate of 9.5%. Now, again, you have to remember, was that product an appropriate product for you to take if you were going to end up getting into the period where it starts to truly adjust? Most folks who take an adjustable rate mortgage are taking it based on the fact that they don't plan on having that mortgage come, let's say, 5 years from now, 7 years from now, 10 years from now, plan on having a mortgage on that property at that period of time. Okay, and that could be because you paid it off. It could be because you sold it. Okay, so sorry for the longer podcast this week. It is just a little more technical product, and even at that, I feel like there's a lot more color that we could add to this to help you understand it. So it's just something that's maybe food for thought, right? As you start to see more of these products come into play, they can totally be appropriate as long as you understand how they work, any risk, and how they would change. Okay, stick around. Pat's going to come back and give you my contact information. If this is something that you want to explore and see if maybe you can save yourself some money on your mortgage by getting maybe a little bit lower interest rate using an adjustable rate product, we'd love to talk to you. One of the most popular products we've done is our 15-1 ARM. It's a 30-year repayment term rate that's fixed for the first 15 years of that 30-year repayment term. That's been a really popular option for a lot of our clients, and it could be something that you could benefit from. So if you need a mortgage, make sure you reach out to me. Pat's going to tell you how to do that. And if you enjoy the podcast, make sure you do me a favor and you go on iTunes and leave us a review. Let others know and make sure you share it, okay? Hey, thanks for listening. Have a good one. Bye.
Homebuyer Radio is a production of Dan Morales, home lending expert with North Point Bank, NMLS number 709729. Dan can be reached at 616-931-4629 or online at danmorales.com. Thanks for listening, and we invite your questions and show ideas at homebuyerradio.com. All loans are subject to credit approval. This is not a commitment to lend. North Point Bank is an equal housing lender. All rights reserved.